The Nasdaq market site. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Dan Kerrigan, also with Nasdaq, and we have Tony Zhang with OptionsPlay. We are going to focus on top strategies for generating income with Nasdaq 100 index options. Gentlemen, thank you so much for joining us at Market Site. Dan, I'm going to kick it off with you. Before we get into the strategies, tell us about the NDX.
Well, the Nasdaq 100 is the performance index. It's returned 230% over the last 10 years. And that's compared with a return of 80% for the S&P 500. So the Nasdaq 100 is the standout performance index for traders and investors alike.
All right, and options can trade on the index as well.
Absolutely. We have listed for trading options under the trading symbol NDX. We call these full-sized options. And then we have a new product on the market, what we call reduced value options, or the trading symbol NQX. It's 1/5 the size. So when the Nasdaq 100 index is at a level of 7,000, NQX is at a level of approximately 1,400. So it's probably a little bit more right size for retail investors.
All right, and Tony, let's talk about credit spreads. What are they and why are they a good fit with the NDX?
So credit spreads are one of the most popular strategies on these index options because it's a strategy that really allows you to generate premium in pretty much all different market conditions. There's two strategies that you can trade. There's the bull put spread and the bear call spread. The bull put spread is the bullish strategy that you can trade. It's a strategy that's constructed where you sell a slightly out of the money put option, which is a neutral to bullish strategy. You collect a little bit of premium for that, but that strategy itself has a lot of margin requirement. There's unlimited risk. So to offset that, what you do is you buy an out of the money put that limits that risk, and that's a bullish strategy that you can trade. The bearish strategy you can trade is a bear call spread, or what's typically known as a short call vertical. That's where you sell a slightly out of the money call option, and that is that neutral to bearish strategy that you're trading that collects a little premium. But in that same strategy also has unlimited risk and requires quite a bit of margin. So to offset that, you can buy an out of the money call option. And both the strategies are very forgiving because even if you're not correct on the directionals trade, and if it just stays neutral on the underlying, you can actually still make a profit from this trade. These trades are fairly high probability of success, which is really why a lot of traders like to trade them. The only trade-off with some of these strategies is that you're typically risking more than double what you're collecting on that premium. So that's one of the things that you have to look out for when you're selling credit spreads.
All right, and Dan, what are some of the key benefits?
Well, for retail investors, there's no early assignment. These are European-style exercise, only once per month, and they're cash settled, so debits or credits as relation to the strike prices. Now with the new NQX options, they also have another benefit. They're PM settled on Fridays, and we offer not only monthly, but weekly options. So regardless of your time frame, maybe you're short term, medium, or longer term, we have a series of expirations that can fit your strategy.
And so, Tony, when you select an expiration, when you select a strike, how do you do that?
So this is really where actually we see a bit of divergence between retail and institutional traders. On the retail side, we tend to see a lot of very short-dated options that are traded 1 to 2 weeks out. These typically trade with very far out of the money strikes as well. So typically what you see is very, very high probability trades that last just 1 or 2 weeks, 80 to 90% probability of profit. But many times these are risking $2,000, $3,000 just to collect $100 in premium. Versus on the institutional side, we see a little different strategy. We see traders going a little further out. They go usually about 2 months out, about 60 days out. They're usually selling strikes that are a bit closer to the current price. So they have a little bit more delta exposure, a little bit more directional exposure, but they usually don't hold that trade to expiration. They'll usually roll those out anywhere from 1 month to about 3 weeks out.
All right, and Dan, what are some best strategies or tips that you have?
Well, I think when it comes to investing, everybody wants to focus on reward, but it's really just as important to focus on risk. So I call it the pillars of option strategies. First of all, are you bullish or bearish on the strategy? We have a lot of volatility at this point in the market, so that's the first starting point. Where do you want to see the market go? But then equally important, how far? Do you have a target price, percentage-wise? And how much time? Over the next week, next couple weeks, or a couple of months? But then also equally important as a pillar is, what's your view on volatility? Will it be expanding or contracting? Putting these 4 pillars together helps cement a trade strategy that is equally focused on reward and risk. And we sure have a lot of volatility in the market right now, a lot of movement to use technical indicators to find oversold and overbought conditions to place some of the strategies that's
All right.
listed here today.
And Tony, I'll ask you the same question as well. What are some best strategies when you're trading these?
So when you look at the markets itself and the NDX, we looked at over the last 20 years, there's about only a 54% probability that the markets will move up in any single week and only a 46% chance the markets will move down. So puts actually have, in this particular trade, a little bit higher edge on the fact that markets have a higher probability of moving higher, and the fact that puts trade at a slightly higher implied volatility also provides you an additional edge. So puts tend to trade a little bit more on this strategy than on calls. And the last part is really the fact that if you do expect a large directional move in one direction or another, this is not the right strategy. You're better off just buying a call or a put or even debit spreads for if you do expect a large move.
All right. Tony, Dan, thank you so much for joining us. And be sure to check out the full webinar with NDX and credit spreads. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.